Thank you everyone for being here. Today, we're going to take the other half of the previous discussion, which was about how TradeMachine calculates the amount risked. Last time we focused on risk for long positions, and today we're going to focus on the short positions. So I'm going to start with the disclaimers as always. I am recording. This is not a solicitation to buy or sell any security ever. This is not advice. You should read the characteristics and risks of standardized options. The results here are provided for general information purposes as a convenience to the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. Investors could lose more than their initial investment. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risks of such investment in light of your financial condition. I'm Jason Hitchings. I'm the CTO at Capital Market Labs. Been working with Ophir for a long time. Okay, so for anyone who missed the last session, which was Thursday, evening, late afternoon, evening, I'm going to do a very, very quick recap for about 2 or 3 minutes of the long risk. Then I'm going to jump into some short strategy risk. We'll do a short put, a short call, short strangle, and a short put spread. And then, as some of you may have noticed, the liquidity filter went live late yesterday for Platinum users, and so we'll do a quick look at that, and I'll talk about how we calculate the liquidity metrics, and then we'll take Q&A, and we'll try to wrap up in about 45 minutes. Thanks again for joining us. Okay, so we talked about this last time, so if you were here last time or watched the video, this will be a quick review. So just as a thought experiment on the long risk, if you were bringing like $100 cash to a game of poker, and then you got up to having like 800 in chips, and then you ended the evening with 200, it's kind of a matter of perspective if you risked 100 or 800. We view the night as essentially your strategy. Your back test would be for the entire evening. So we view it as you came with $100, you're risking $100. And if you left with 200, then that would be a 100% return. That's how TradeMachine views it. If the same situation happened, but you had a buyback and you ended up kind of bringing a total of $200, if you ended up leaving with $200, then we consider that to be, break even for the night. So in short, the risk in TradeMachine is the cost of the trade plus any commissions minus the cash from previous positions, whether positive or negative. I actually had, it's asking me to sign in again. That's odd. Okay, this will be fast. I actually had a typo last time, so just jump past it here. So this should say 0% return. Okay. So if you bought a long call, your risk would just be if you bought a long put, your risk would just be the cost of the initial position. Same with the call. If you bought a long call, it's just the price of that call. And that changes once we move over to short. The way that we look at the risk of a short, you could say if you sell a put, then you're risking the chance of it going to zero. I mean, that would be a perfectly reasonable way to look at risk, is that the risk is worst case scenario. We view risk for short positions using basically something very similar to the margin requirement. If you look at Reg T margin, there's two different ways to calculate margin. There's quote unquote portfolio risk, or there's sort of position risk. And Reg T is the normal way that brokerages do it. So we're basically using like a Reg T calculation, and there's a couple areas where we're a little bit more conservative. So if there's different ways of doing it, then we might choose the more conservative one. But we'll just start in the previous, live help session. We looked at this same example of like NVIDIA. We were looking at long calls and short calls. So we're going to look at the same we looked at long puts and long calls last time. Now we're going to do the same thing, but looking at short puts and short calls. And so in this trade, the user starts off short, that same option that we looked at previously. And it was, you took a credit of $21.38 times 100, and then it was profitable. And so the way that we calculate that is using this Reg T. And I chose some examples from Tasty Trade, some examples from Interactive Brokers, just for how they spec out the margin requirements. It's actually defined in like a SIBO margin requirements document is kind of the definitive version for Reg T. There's actually regulatory stuff if you want to get it, SEC has their own versions of it. But basically what this says, it's the price of the option that you have to keep in your account plus the maximum, the greater of either 20% of the stock price minus any amount that it's out of the money, or 10% of the underlying price. And I'll break that down into details because it sounds a little complicated. Okay, so let's look at this example. We have this short put for 21.38. Somehow we came up with this 82.36 calculation, and this is how it got broken down. And there's a little extra piece of subtlety here. So the position was 21.38, and then you take the max of 20% times the stock price minus the out of the money amount. And that means basically the reason they do that is that the more out of the money the option is, the less at risk you are. If you're selling a put and the stock's trading at 200 and you're selling a 50 strike put, it's very, very far out of the money. And so they don't consider that you're risking very much. But if it's so far out of the money that it's actually more than 20% out of the money, then they basically say, well, you need to hold at least 10% of the value of the stock as part of the margin. So in this scenario, it's a 40 delta put, so it's a little bit out of the money. We have a 450 strike, and the stock is about 460. And so when you look at this, you subtract the out of the money amount, you end up with 91.91 minus 955 times 100. So you end up with 82.36 as one of the two calculations. The other calculation ends up at 45.95, and so you take the greater of the two. Now the question is, what happens to this 21.38? If you're supposed to have the price of the option plus this, then isn't the risk actually 10,374? This is what the maintenance margin is. So you would have to keep this amount in your account in order to not have a margin call on this trade. But as soon as you place this trade, you immediately take a credit of 21.38 into your account. So the amount of additional capital that you would need to have and hold in order to have this position on is this 82.36. And so that's the additional money that we see you as needing to have tied up into this position. And so when we do our risk based off of a Reg T, we say, okay, what's the additional amount of capital that you need to have beyond just the credit that you receive initially? So that's how we come up with that 82.36. Okay, now we're going to look at another example. So that's just what I said there. Okay, so now we're going to look at the short call, but I'm just going to look on day one. You might remember that short put traded at a profit. So right now I'm just going to look at the initial risk for the short call. So I'm doing a 40 delta short call in this NVIDIA as well. traded at a price of 17.27, so you took that as a credit initially. And we're going to look at the same calculation here. Now, the strike that got traded was this 45. Stock price is around 460, and it's going to be the greater of these two. The first calculation, you end up with this 66.46, and the second one, you end up with 45.96. And so you can see that the amount risked here is the 66.46. But that's just for day one, because as this position changes over time, in this scenario, NVIDIA went up. And so that option was less and less out of the money, maybe started even becoming in the money up here, and the amount of risk increased over time. So we ended up, if you held this position for roughly 10 days, that the amount risked on that trade ended up being 99.31. So with short positions, we're kind of constantly reassessing the risk, and we're saying, what's the max risk over the entire lifetime of the trade? Because your brokerage account, if you didn't have enough money in it, they'd ask you to deposit more, or potentially they'd liquidate the position. So we're assuming people are staying ahead of that, in this theoretical scenario. We're saying the amount of capital that you had tied up in here. Reg T is basically based off of, what's a reasonable scenario for, it's not really worst case, but it's what's a reasonable case for like a really bad outcome. And that's what this margin is based off of. So with these short strategies, the risk is continually reassessed as time moves on, and so the risk will change from the initial time you put it on. Generally, with a long strategy, if you buy a call, the amount that you're risking is just the initial premium of the call, and the risk won't get reassessed until you close the position, and then now you have a net cash change, so you lock in that profit or loss, and then you take the next trade. If you lock in a loss, then we're saying, okay, this entire strategy has that loss. It's kind of like when you had to go buy back, at your friend's poker game. So now you have that, say, minus 100 in your account. And so then that would get added to the total strategy risk. But while the strategy is in place, generally with the long strategy, it just stays fixed over the course of the strategy. I'm going to look at a short strangle straddle in a second here, but I just wanted to, for completeness, show the long version of this. So if you did the call and the put, you can see the risk here in TradeMachine is 38.65 for this trade. And that's just real simple. It's just you're putting at risk the both premiums. If stock landed anywhere between 450 and 485, both these things would be worthless. And so you'd be at risk for the full amount of premium, or full amount of really the option price for both options. So now we're going to look at short strangle straddles. I know there was a question last time in terms of how those are computed, and someone looked at it. If a question got forwarded to support, I didn't see it, but I know there's a question about it, so I wanted to look at those as well. And so again, we're looking at this risk from the perspective of margin. And when you're looking at it in margin, we don't just add up the risk of the call and the risk of the put, because when you're short a strangle or straddle, unless they're in the in the guts, quote unquote, unless you're selling two in the money options, only one or the other is going to end up losing. If you're lucky, neither one. If you happen to land in between the two strikes or at that strike, then they can both win. Or if you're within the range of credit that you receive, if you receive $5 of credit and you're selling the same strike and making a straddle, then if you're within $5 of that strike, then you should end up in the money. But it's not the same as selling a short put at one point in time and then at another point in time selling a short call, because those could both move against you. They could both end up in the money by $100 if they're happening independently. If they're happening on the same expiration, then it's really only the greater of the two that is at risk. So pretty simple. So for simplicity's sake, I'm just looking at one day, and it's just the greater of the two. So right now we see that the put has a risk of 82.36, and the call has a risk of 66.46, and so the strangle here just has the greater of those two as the risk. All right, so now we're going to look at like a short vertical spread, and this was taken from Tasty Trade. It says the margin requirement for a short vertical spread is equal to the difference between the strikes multiplied by the number of spreads. The credit received from the spread may apply to the margin requirement. So you kind of have to hold that as well. So let's just look at a quick example. So here I kept the deltas close, I kept the strikes close on purpose, and I shorted the 40 delta and we're long the 35 delta, and so those strikes worked out to be short the 450 put and long the 440 put. So this is pretty logical. Like, what's the amount of credit that you receive? And the credit is for 11. And then what's the worst case scenario? You know, the worst case scenario is that it goes all the way through. It goes down below the 450, and then it goes all the way through the 440, and then all the way down to 0. You're covered equally the same. So this spread ends up being $10 in the money in the wrong direction for you. So the worst case scenario for you is that the spread becomes more valuable because you're short, and the most it can become worth is $10, you know, per share. But you collected for 11 at the beginning, and so you ended up being, you know, a net loss for roughly 589 decimal gets rounded to 590. So that one I think is pretty intuitive for people that have some experience with you know, level 2 and 3 options. The one caveat that's not included in this small write-up is the fact that it will never be worse to have that protective put than it would to be short a naked put. So if the stock's trading at whatever 120 and you sold the 100 level put, and then for catastrophic protection you bought back the 50 level put, that they're not going to have you put at risk $50 because it won't be more than 20% of the value of the stock. So that was kind of one small piece of, you know, information that was slightly incomplete. And this is that it won't be worse than just having the two positions independently. Like the protective put will never hurt you. I mean, each brokerage has their own way of calculating it, you know, but Reg T doesn't require that, and we don't ever have the risk worse than just having the two positions independently. Right, so that was kind of a quick summary of, you know, the main strategies within TradeMachine. Like logically, you know, you can kind of extrapolate from that what iron condors and things like that, how those would trade. I'm not going to do a deep dive into custom strategy risk today, but I'll just kind of say briefly that basically we're trying to pair off all of the legs in order to make the lowest risk position possible. So kind of trying to find the riskiest short legs and pairing them up with long legs. And we're kind of doing that piece by piece of the strategy. And then if we're left with naked options, then we just treat those as naked option risk. So we kind of break the strategy up into its individual components. Great. Okay, so we mentioned liquidity filter, and so we're going to take a quick look at that. That's currently available for Platinum members. And so right up here, we see this liquidity filter. It functions much the same way that the symbol filter does here. This is filtering on what group it belongs to, either the Dow 30, the NASDAQ 100, or the largest 500 by market cap. So this will filter every time you move up on the scale. It will show fewer results, or either the same or fewer results. And this is based off of the spread in the options market. And we look at options that are as close as we can to 30 days in the future. And then we look for options, both a call and a put, that are as close as we can to a 25 delta option. So, you know, somewhat out of the money. And then we look at the width of that market at the end of the day. And we look at it, the width in an absolute terms, like is that width 5 cents or less? We have a rule that says if it's only a nickel wide, we consider that to be a 5 out of 5, regardless of what the stock price is. Also, we have an additional filter says how big is that width as a percent of the stock as a whole? So if a stock is trading at $10 and the width is 50 cents, we view that as the same amount of liquidity as if a stock is trading at $100 with the width of $5. And I'll pull open the Learn tab and look at that in detail. But each time you click on one of these, it will reduce, either none will be eliminated or it'll slightly reduce. And by the time you get up to 4 plus and 5, you should be seeing things that are highly liquid. We kept this relatively simple and got it out, and we very much are welcoming feedback. So please let us know if you click 4 plus, you click one of these, you look at it and you open it up in your brokerage and you're like, hey, these look really wide. Let us know. Send us a screenshot and tell us what you're seeing, and then we can always adapt. But from the testing that we've done, it does a pretty darn good job. And I'm going to take a quick look at the Learn tab here. And if you type in liquidity, there's this nice write up here. And these are the rules. So if the spread is less than or equal to a nickel, we consider that a 5 out of 5. Or if it's 0.25% of the stock price. So a very small percent of the stock price, and we consider that to be highly liquid. We adjusted these some initially. We had these a little bit too permissive, and some things weren't as liquid as we wanted. So we kind of tightened these up and reran everything. And from the analysis that we've done, these have worked out pretty well. So down here, by the time you get to a liquidity score out of 3, it means that the width is 1% of the stock price. So on a $100 stock, dollar wide would give you a score of 3. The score will get better if it's, these rules also apply. Like it will, if it's a nickel wide or 10 cents wide or 20 cents wide or 50 cents wide, then it will always be at least that good of a score, 5, 4, 3, 2. So it's either one of these things, and the better one, you'll get the better score. The one little caveat is we said if a stock is trading at $4.25, we just kind of made a cutoff at $5 and said we're going to give it a max liquidity of 3, because now you're just kind of talking about stocks that are a little bit more on the fringes, and it just are a little bit less predictable in terms of what their markets are going to be doing. And so we said if it's under $5, then we give it a max score of 3, even if it looks relatively tight. And I think an area in the future where we might, between like say 5 and 10, or maybe certain stocks are trading at 350, but the markets are penny wide. We're very open to feedback if you guys start looking at these and you have feedback on it. But yeah, that's version 1 of the liquidity filter, and we're pretty happy with what we're seeing so far, and we're excited for the Platinum members to start giving us some feedback. And this is a feature that we might very well roll out to everyone once we get some initial feedback on it. Great. Okay, with that, I'm happy to take any questions.
All right, we don't have any questions in chat right now, but if you have some, go ahead and drop them in chat. While we're waiting on those to come in, I would say if you have interest in upgrading to Platinum, liquidity filter is one thing that you're going to be able to test now, but you also get expanded range of back tests. You can back test up to 200 tickers at a time, faster back testing speeds, and you get the options on the triggered now feature. So
yeah, and I might just do a quick, for anyone who's brand new here, a deep dive on short risk might have been a little more than you were bargaining for. And so I think I'll just take 1 minute here to go over just a real quick introduction for new users. And then people can, think of if they have any questions. Otherwise, we're happy to wrap up. We try to keep it between 30 and 45 minutes, and we're at about 25 minutes. I will just respond. Carl said, "Hey, my audio is cutting out periodically for a second or two. Sorry if anyone else is experiencing that. Hopefully, it didn't mess things up too much." Dave asks how much the update is. Yeah, for Platinum, it's actually less expensive. We just ask for a yearly commitment. So you just email support, and we'll get you turned over on that. That just helps us normalize a lot of things with our servers and data feeds and all that kind of thing. So it just helps us if people if can do it at a year at a time. Generally, get if you're standard user paying standard current prices, then you get about a 15% discount on the year. So it's a win-win. Okay, so for anyone that's brand new, and I see a few questions coming in, but I'll just give a real quick 2-minute introduction. So when you first land on TradeMachine, you're going to see all these different strategies. Some haven't triggered, but anything that appears on this tab, we call it the Today tab. If it says today here, it means it's a strategy that was active, today at some point. All the technical and earnings conditions were true. Any one of these strategies you can dive into and take a deep look at by clicking the question mark. Some have videos right inside of them. And then if you click the ticker, it's going to open up that back test and you can take a look at how that has performed historically. And if this little green flag is here and it says triggered and it's green, that means it's still active. So in this case, the technical condition is that the stock has to be greater than the 50-day moving average. And then there's some earnings rules, and it says that it's going to open 14 days before earnings. So you can see that the next earnings here is April 30th. And as a quick reminder, if that's all it says, then you can feel confident that's when the earnings date's going to be. If it says not verified, then you might want to think twice or do your own research about the earnings date. But generally, if they're appearing in the Today tab, you'll see they'll be for verified earnings only. Yeah, and this means that it's active. TradeMachine places its trades at the end of the day. So if you want to follow TradeMachine as closely as possible, you can wait till the end of the day to place the trade. I think that's a matter of taste, whether you are willing to make that kind of time commitment in order to only trade in the last, 15 minutes of the day. I tend to, unless I have warning flags going off in my head about something else, I tend to just personally just take the trade when I see it active. This is a little additional feature that yearly Platinum members get. If you click Show Options, then it'll tell you the exact strike and expiration for the strategy, which is a little bit of a time saver. Otherwise, you can just look at the deltas. So this was a custom strategy, so it's a little bit more complicated for new users. All of these strategies here, they say either advanced or intermediate or beginner. The beginner tend to just be one simple leg. Like this, bearish burst or bullish burst will just be, buying a call or buying a put. But yeah, that's a great place to get started. And then there's obviously you can do your own back tests and portfolio back tests and all that good stuff. There's a lot here. The Learn tab is full of great resources. There's also options education if some of this stuff is a little bit new. And then there's a community. You just quickly read and say, yes, I'm gonna, have just not talk politics and not be negative towards people. And you can dive into community and ask all the questions you want. The TradeMachine, if you have both products, you'll see both. But for TradeMachine users, yeah, ask questions, get trade ideas. Lots of great stuff happening here. Okay, we have a couple things coming in here. Okay, so Tracy says, I am a new user and had a question on alerts. I currently have 250 set up, so setting them up is not an issue, but I'm still struggling on the execution of these alerts. Great. So when you see an alert come in, I cleared mine out recently, but when you see an alert come in, it's basically going to give you a share link. So if I create an alert here, I can give you a good example. Basically, when an alert comes in, they're gonna behave pretty much exactly like this. You can actually set alerts on these, so you can say which of these you want to get alerts on. So this is for which tickers. So if you only want alerts on, say, stocks in the S&P or the largest market cap, you can choose the strategies you want to get alerted on. You'll get an email with that alert. When you get the email, it's going to say what the strategy was that triggered, and it's going to give you a link. And so if I had subscribed to these 14-day pre-earnings calls, I would get a link like this that would say RSG triggered today, and then it would tell me what the technical conditions were. It'd say the stock is above the 50-day moving average. It'd say the stock is currently at 187, whereas the 50-day moving average is at 184 or something. When you click that link, it's going to pull up a page like this, and this little green banner here indicates that this is still active. You know, the conditions are still true, the earnings conditions are still true, all of that kind of stuff. It's not saying that the strategy, that the back test is ready to open a trade, because this is assuming that you want to put on a new position. So it'd be kind of like you're starting the back test on 4/16/2024. So it's starting a brand new position. So if you ever get a little bit confused because you're like, well, it didn't seem to open a trade today, the alerts are based off of the assumption that you don't have a current position and you're waiting for the right time to open it. If this is green, it means it's ready to open the position. Now, let's say you're not a platinum member, so you don't have this little handy show options thing. What this is saying is that this strategy is 30 days to expiration, and it's a 40 delta call. 40 delta means it's a little bit out of the money, and you're looking for something as close to 30 days in the future as possible, and you want to buy a long call. So we'll see if this one has, helpful options chains. We get these from the CBOE. So I'm going to look at here. I'm going to say, okay, what's the closest to 30 days in the future? Well, we happen to have one that's 31 days, so that's a nice and clean one. I'm looking for a call, so these are the calls. And I'm looking for a 40 delta. So which one of these is closest to 40 delta? And I would say this May 17, 190 call. So this would be the option I would buy. Now the midpoint is 345, but obviously when you go into your brokerage, then you'll see, how wide the markets are and that kind of thing. And these are slightly delayed, so the actual option prices, the stock is current, but have a look at the option prices and make sure the markets make sense for you. But yeah, that's the trade you would place if you wanted to enter this strategy. For annual subscribers, you can click the show options and it just shows the exact same thing. Now it could have more than one leg. So if this was a put spread, let's see if so little nuance here. This says long the 40 delta, short the 40 delta puts. So that's not a strategy you can actually do. Gappy long and short the same thing. And so I click this little settings gear and I say, I'm using my own deltas. And so I say, right now, this is a long put spread. So I'd be long the 40 delta, short. Now I'm going to say the 30 delta. So a little bit more out of the money. Delta just tells you more or less how far out of the money something is. 50 delta is out the money. We use delta because it's a little bit more precise than saying $5 out of the money. Because if stock goes from $20 to $500, being $5 out of the money is very different. But delta kind of captures all of that. But now when you click it, it shows both. It says, okay, well, you want to be long the 185 puts and short the 180 puts. But it's the same logic. You just look at the 40 delta and the 30 delta. You can do it here, or your brokerage ought to have it as well. So you could filter by 30 days and say, okay, now we're doing the put spread, and we're looking at the closest we can to those two deltas. So I hope that was helpful. We know Delta feels a little tricky for some people initially. We have some good learning resources on what Delta is on the Learn tab. It ends up being more precise and giving you better results. We do it because it's going to give you a better simulation, better back test of what's happening in the market. Are leap options not part of the TM strategies? We don't have a lot of leaps like pre-built in to the strategies. For instance, if you're going to do an earnings trade, buying options, 2 years out with earnings, you know, if you're typically going to do an earnings trade within whatever a few weeks or a few months. Like if you're capturing multiple earnings events in one leap, then it's kind of a different sort of strategy. We don't have that many built in ahead of time, or really nothing that's like really far out, but you can do any kind of backtesting you want. So if you're saying, for instance, so we have all these save strategies here. So if you click save strategies, so you can say, I like the fade the dip AI strategy. I click save strategy. I click load. Okay, but this is 30 days out. You're like, okay, that's done fine. The 2 times that it's triggered has done fine. What would happen if I was using, options a year out? So by just changing the days to expiration, you can turn any one of these strategies into a leap strategy. Now, I'm going to draw your attention to the fact that now we only have one trade. The reason for that is because you were still holding the position when the next time it triggered, and TradeMachine won't reopen the trade if it's already open. So you can do portfolio backtesting. You can do anything you want. You can create custom strategies where you could add, different legs of different durations, etc. So there's anything that you can do for shorter term options, you can certainly do for longer term options as well. But ours typically tend to be operating in the sort of 7-day to 60-day time frame. Some strategies include buying options like 40 delta calls. What are your thoughts of reducing the price of the option by selling bull put spread against it as a combo? Yeah, I think it's great. I think I would just backtest it. I backtest it both. So you could see something gets triggered for a 40 delta call, and then you could say, okay, what happens if I, you know, sell a put spread instead? And I mean that's essentially what the fade the dip is conceptually similar to that. It's like, there's when it's low, we're selling. Sometimes because of the way that, volatility works, sometimes there's certain kind of market conditions where you might want to own options versus being short options. So I think it can be great. I would just backtest it, and I would backtest it not only against one. So let's take an example. Um, so this is these pre-earning 7-day calls. So I'm going to click one. So this has won 6 times, lost 2 times. It's currently active. But you're saying, okay, how would this have done if I was short a put spread? I'll make sure the deltas are good. Let's see here. Yeah, see, we ended up with the same 40 delta, 40 delta. So I'm clicking here. I can also just get rid of my own deltas, and it'll kind of set some that make sense. Okay, so then, being short the put spread, this is how that particular strategy has done. For this stock, not quite as well. So at that point, I'd probably say, yeah, I'm just going to stick with the long call. But if it did do relatively well, I might also test it against, a larger batch of stocks and see how that performed as a whole. I will say that when we develop the technical conditions and some other things, we are taking into account sort of a lot of market conditions when we create those. And so, for instance, being long a call going into earnings isn't a coincidence, because as you go into earnings, there tends to be more anticipation of the movement and more volatility. And if volatility is increasing, then owning options tends to be better for you. So I'd say we're intentional about if we're long calls versus short puts or short put spreads. Um, but sometimes, you might be better off owning a call spread instead of just a naked call, for instance. And so I definitely recommend that you play around. That's the power of TradeMachine, is that you can adjust to, your own trading styles. And I have seen, even with like buy the dip, I have found that recently like put call spreads tend to work a little bit better. We intentionally wanted to have some strategies, and I think Max kind of came to the same conclusion. I think he actually posted on community about it. Um, but we wanted to have a couple in here that were single legs, because not everyone has level 2 options. Not everyone can spread, etc. So, And so for some people, it's a lot of complexity to start with. So we wanted to have a couple in here that were just like individual options. But a lot of these can do very well as, being turned into spreads. Okay, we got about 5 more minutes. I'll try to get through a couple more of these. How many portfolios can a premium member create? There's not a limit on the number of portfolios. For premium platinum members, you can have 200 stocks in an individual portfolio. For normal members, it's 100. Jake says, thank you for the early explanations. Great, glad that helped. Paul, a long 50 strike, short 60 strike call debit spread is synthetically identical to a short 60 strike, long 50 strike put credit spread. They will achieve the same profit loss outcomes regardless of what the market does. You calculate the different risk amounts for each. That will also make the average return percent different for each spread, despite them performing identically. Makes it hard to rely on the average return percent. Yeah, when it comes to agreed, everything you said is correct. When it comes to short positions, we just use Reg T. It's just a different, methodology. But I take your point. Robert says, are you still adhering to the trigger being green 15 minutes before the close? For example, Amazon went in and out of the trigger. Yeah, so that happens. Things, that's why we have that feature is like people had to check the technicals themselves previously. But sometimes you'll click on something that was active, an hour after the market opened, but it stopped being active. The market can move one direction and then come back down. So this will show that it's not active anymore. If it's on the Today tab, it just means that it was active at some point during the day. My personal approach is if it is active in the moment I'm looking at it, then I'll proceed with the trade. But if you want to really stick as close as possible to the back test, then you could wait till the end of the day and make sure it's still active. Tom says I meant buy 40 delta call and sell the 40 delta buy 30 delta but 3-leg combo, as in reduce the price of the call by selling a spread against it. Okay, got you, Thomas. Yeah, so you could for that you could just test a custom strategy, but my general response would be the same. If you have an idea of a different way to construct the strategy, I think that's awesome. If you find one that you think is performing well, please post it on community. We'd all love to see it. And I would say just backtest it on the individual symbol and then backtest against a basket, at least the Dow 30 or the S&P or the NASDAQ 100. And if you're seeing that it's doing well, especially if you're seeing that, for the last 2 years, this is outperforming the default strategy. I tested fade the dip against the NASDAQ 100 for the last 6 months and last 2 years, and I tested this other strategy and it performs better across the board. That's gold. And I mean, we spent a lot of time coming up with the strategies that have had good trends like that. And so, yeah, I think that's awesome. Please, test it and please share your results if you find something cool. Awesome. Great. Well, thank you everyone for being here. Appreciate it. And I think we're going to do a special session next Monday for brand new users. So if this felt like a lot and you're a new user, don't worry. We're gonna take it real slow and go through step by step. The risk discussions was kind of a more nuanced, slightly more complex topic, but it's something that people have had a lot of questions about, and so we wanted to do a deep dive there. But please join us next Monday. I think it's going to be one that's later on in the day, kind of more towards a little after the close. And we'll take a nice slow walk through TradeMachine and answer questions for a lot of new users. And yeah, I'm glad to hear that you're excited about the liquidity, Kurt. But yeah, thank you everyone for being here. We're going to do these, once a week, and we're happy to answer your questions. Please check us out in community, email support, and ask questions there. And the Learn tab has a lot of resources. So thanks for being a member, and I look forward to seeing you all the next time. You got it, Carl. Thanks, Jim. All right, bye everybody.